Hi, in this presentation, I will focus on the first adjustment to profits that need to be made in order to arrive at cash flows. This adjustment relates to depreciation and amortization. Depreciation and amortization are expenses that are charged to revenues in order to arrive at profits. The difference between depreciation and amortization is that depreciation is applied to long-term physical assets such as buildings and cars. Amortization is applied to long-term intangible assets such as goodwill or even brand value. Even though depreciation and amortization are expenses, they do not result in any cash outflows. The cash outflows happen when the assets are acquired, not when they are depreciated or amortized periodically after acquisition. As an example, think about buying furniture for your company. Now, there is a cash outflow when the furniture is bought. The supplier has to be paid. But the furniture may have a life of 5 years, and each year a certain amount is depreciated to show that the furniture has been used. This depreciation is indeed an expense. But when you depreciate, do you have to pay the supplier again? Certainly not. Therefore, depreciation is an expense, but it involves no cash outflows. Likewise, amortization is an expense that involves no cash outflows. But depreciation and amortization help to reduce taxes, and therefore, indirectly, they have an effect on cash flows. So, when a company saves taxes, it reduces cash outflow. So, depreciation and amortization do not directly affect cash flows, but they indirectly affect cash flows through the tax savings, and therefore it's important to consider depreciation and amortization in computing the cash flows. So we need to know how much taxes do we save by charging depreciation and amortization. So the amount of tax that depreciation helps a company to save is called the depreciation tax shield. So it is computed as depreciation in dollars multiplied by the tax rate in percentage. For example, if a company has $100 as depreciation in a particular year and the tax rate is 30%, then the tax saving is $100 into 30% or $30. So in effect, $100 of depreciation provides $30 as tax shield. So when we convert profits into cash flows, we first calculate the profit after tax. And when we say profit after tax, it means the profit has already taken a charge on account of depreciation and amortization. And now the profit after tax is to be converted into cash flows from operation. And to do this, we add back the depreciation and amortization. Here we assume that there are no changes in working capital, and the effect of changes in working capital will be discussed, it will be presented in the next presentation. But for now, if you are trying to convert profit after tax to cash flow from operation, just remember that you need to add back the depreciation and amortization to the profit after tax. So what is the big picture? Start with net profit after tax, add depreciation and amortization, you get the cash flow from operation, all assuming that there is no change in working capital. The effect of change in working capital will be discussed next.